Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. So jumping right in today, we are doing a deep dive into a really fascinating setup in the AI infrastructure space.
Yeah, Nebius is definitely one of the most interesting plays on the board right now.
Totally. And our goal today is to really frame this around wealth building. You look at this company, they are sitting at a $22.97 billion market cap.
Right.
And the big question you have to ask yourself is whether this high-growth trajectory is a genuine multi-bagger opportunity or if it's leaning more toward a high-risk, overvalued tech play.
Which is the exact tension the market is grappling with right now. Because, there is this glaring contradiction with Nebius right out of the gate.
The revenue miss.
Exactly. They recently had a top-line miss.
Right.
And normally, in this hypersensitive tech environment, a revenue miss triggers an absolute bloodbath.
Oh, massive sell-offs. Everyone runs for the exits.
Right. But major analysts are looking at the price resilience here and literally describing it as defying logic.
Yeah.
Because despite the miss, they are still posting these massive year-over-year returns.
It's wild. The market is basically giving them a pass. And I think to understand why, we have to look at the sheer scale of the growth engine here.
Yeah.
Because when you look at their latest period ending December 31st, 2025,
The numbers are just staggering.
they really are. We are talking about 479% revenue growth.
Yeah.
Seeing nearly 500% top-line expansion from a company that is approaching a $23 billion valuation is, well, it's highly unusual.
It's almost unheard of. Historically, growth at that velocity is reserved for those tiny microcap startups that are just figuring out how to monetize.
Right, not a large-cap enterprise.
Exactly. For a company of this size to sustain that kind of momentum, it indicates a structural shift in their addressable market. It's not just a lucky sales quarter. The sheer volume of incoming revenue is overwhelming the standard valuation models, which is why institutions are looking past that slight quarterly miss.
And it's not just the top-line revenue either. For your portfolio, the quality of that growth is what really matters. We see so many companies in this sector just burning billions in cash, basically subsidizing their clients' compute costs just to grab market share.
Hoping they can magically figure out profitability a decade from now.
Exactly. But Nebius has actually achieved EBITDA profitability.
Which completely changes the risk profile.
It does. Let's look at the margins. On a trailing 12-month basis, they're sitting at a 68.63% gross margin.
That is massive.
And a 5.47% net profit margin. They even have a trailing 12-month EPS of 0.11. That gross margin, approaching 69%, is really the critical data point for any wealth-building thesis here. Because traditional infrastructure plays, the companies that just buy hardware and rent out compute time,
Right.
they are trapped in a race to the bottom. Their margins always compress as compute becomes commoditized. So Nebius, generating a 69% gross margin, tells you they have incredible pricing power. They are operating much more like a high-margin software business than a hardware vendor.
Which explains how that incremental revenue is actually dropping to the bottom line now, rather than just being burned on operational overhead.
Right.
But to play devil's advocate for a second, let's look at the balance sheet.
Sure.
The debt-to-equity ratio is sitting at 89.5%.
Right.
For investors who use traditional value metrics, seeing nearly 90% debt-to-equity in a high-interest environment usually screams elevated risk, especially for a tech stock with a high valuation. It does look scary on paper, but you have to understand how that leverage is being applied. In the current AI arms race, the barrier to entry is entirely dictated by your ability to deploy billions for next-generation GPU clusters.
Getting the chips is half the battle.
Exactly. And funding those build-outs before the revenue actually materializes requires really aggressive balance sheet management. So that 89.5% DDE ratio isn't reckless borrowing to cover operational cash burn.
Right.
It is a highly calculated structural necessity. They are leveraging up to front-run the infrastructure demands of their enterprise clients while demand is completely inelastic.
Oh, yeah.
And because they are EBITDA profitable, they can easily service this debt profile.
Okay, so that distinction between a traditional hardware vendor and what Nebius is doing, that brings us to their competitive moat. Because if an enterprise just needs raw compute to train a model, they could easily go to a pure GPU provider.
Like CoreWeave.
Exactly, like CoreWeave. They provide the bare metal. But then the enterprise still has to build the entire data pipeline, source all the developer tools, and manage the deployment entirely on their own.
Which is a massive headache. And that is where Nebius comes in. They are positioning themselves as a full-stack platform. Analysts are calling it their hidden AI platform.
Let's unpack that. What makes it a full-stack platform?
So they provide the underlying GPU clusters, obviously, but then they layer cloud services, specialized developer ecosystems, and crucial data management tools right on top of it.
Like Toloka.
Yes, Toloka is the perfect example. It's deeply integrated into their offering. It provides the essential tools for data labeling, model fine-tuning, and handling all those human-in-the-loop processes that are absolutely mandatory to get an enterprise AI model into production.
And that integration directly drives what might be the most important metric we're looking at today. Nebius has a 100% software attach rate.
It is the holy grail for an infrastructure provider.
Literally every single client coming to them for raw GPU power is also adopting and using their proprietary software solutions.
Right. Think about why that matters for your portfolio. A 100% software attach rate creates staggering switching costs.
Oh, absolutely.
Let's say you're a major enterprise in healthcare or robotics. Once your data scientists build their pipelines natively inside Nebius's ecosystem, integrating everything with tools like Toloka,
The friction to leave is just immense.
it becomes prohibitive. To save a few cents on hourly GPU rentals with a competitor, that enterprise would have to tear down their entire development environment, retrain their whole engineering team, and risk massive downtime.
So the hardware gets them in the door, but the software ecosystem effectively locks them inside.
Exactly. It makes the product incredibly sticky and completely shields those 69% gross margins from hardware price wars.
Knowing they have that sticky moat really contextualizes how they are spending their free cash flow. They just pulled off a $275 million acquisition that is specifically targeting agentic AI infrastructure.
This is a huge pivot. It points to a massive shift in how they view enterprise demand going forward.
Right, because agentic AI is very different from what we've been seeing.
Fundamentally different architecture. Generative AI is conversational and stateless. You prompt a chatbot, it gives you an answer, the transaction is done.
The AI agents.
Agents are autonomous.
Yeah.
They execute complex, multi-step workflows across an entire enterprise's internal systems without a human holding their hand.
So if an AI agent is tasked with fixing a supply chain bottleneck, it has to dig into inventory databases, draft emails, adjust procurement software, and monitor those actions over days or even weeks.
Which requires infrastructure optimized for low latency, persistent memory, and continuous compute, not just short bursts of processing.
By dropping $275 million on this specialized infrastructure, Nebius is basically building the tracks for where the entire industry is heading.
Preemptively.
Hmm.
They aren't just reacting to current demands. They want to be the default environment where these autonomous workflows actually live.
Which cements their transition from just a hardware provider into a core enterprise workflow engine.
And when you look at the rest of their ecosystem, it all starts to click together. They have Nebius Academy, and they have these really strategic partnerships around ClickHouse.
Right. ClickHouse is a massive piece of this puzzle.
It is,
Yeah.
because it's an incredibly fast, OLAPic database. It is perfectly suited for the real-time analytics and vector search capabilities that these AI agents need to maintain their memory and context. We should definitely expect to see some major integration reveals around these technologies at the upcoming AI conferences.
And as the market digests all of this, how deeply Nebius is embedding itself into the daily operations of these massive clients, we're seeing it reflected in the momentum. The price action on the chart is just striking.
The technicals are wild right now.
The 52-week range alone is incredibly wide. We're talking a low of $18.31, all the way up to $141.10.
That is a massive spread.
And look at the one-year shareholder return. Nebius delivered 227.2%. To give you some context, the broader U.S. software average return over that exact same period was 18.4%.
So they are absolutely smashing the sector average.
By an order of magnitude. Now, obviously, a 227% run-up is going to make people nervous. You naturally start worrying about valuation exhaustion.
Sure, a lot of retail investors might look at that and think they missed the boat. The major move already happened.
Right. But when you dig into the underlying volume and institutional flow, it tells a very different story. May 7th.
That was a huge signal. We saw 22.94 million shares traded in a single session. And their baseline average volume is only 13.65 million.
Almost double the average volume.
And crucially, there was no catastrophic negative news to trigger a dump. A volume spike like that usually means major institutional repositioning, accumulation.
Yeah, we've been tracking these whale alerts across the data. Massive institutional block purchases. The Q4 2025 portfolio update from the Alger Dynamic Opportunities Fund specifically highlighted significant accumulation of Nebius stock.
And the Alger Fund isn't throwing darts. They target high conviction, high growth equities with real momentum. When smart money like that is backing up the truck, especially while the stock is seeing 13% weekly volatility.
It tells you their internal models see way more upside than the retail market is currently pricing in.
Exactly. These institutions are not day trading a stock with a PE ratio over 260. They are taking long-term positions because they project massive earnings acceleration.
And their confidence seems directly tied to Nebius's ability to maintain high average selling prices, or ASPs.
Which goes right back to that software attach rate. Because it's 100%, they don't have to discount their compute power.
Right. But there's also a strategic shift happening behind the scenes that we need to talk about. The customer financing shift.
This is a brilliant move on their part. Nebius is actually helping their enterprise clients structure the financing for these massive infrastructure deployments.
Which directly attacks the biggest friction point for adoption.
Capital constraints. By financing these deals, Nebius pulls the revenue forward and locks in these long-term contracts. It dramatically lowers the risk profile of their sales pipeline, and that gives institutions the predictability they demand.
Okay, we have painted a very bullish picture so far. But to be fully objective, we have to flip the script and give some serious weight to the bear case.
We definitely do, because there is real risk here.
The most glaring red flag is that price-to-earnings ratio. It is sitting at 260.96.
Yeah, a PE of 260 is priced for absolute perfection.
Combine that with 13% weekly volatility, and any execution misstep, any delay in the rollout of this new agentic AI infrastructure could trigger a very violent multiple compression.
The primary structural risk that is terrifying the bears right now is CapEx intensity, capital expenditure.
It's the black cloud hanging over the whole infrastructure sector.
Building and refreshing these AI data centers takes billions of dollars constantly. The life cycle of a high-end AI chip is shockingly short.
Right. If Nebius buys tens of thousands of current generation GPUs today, they face massive depreciation risks if those chips become totally obsolete in 18 to 24 months when the next generation drops.
Exactly. The bear argument is that infrastructure companies are trapped on a treadmill. They are forced to spend themselves into the ground just to stay relevant, hoping they survive long enough for the broader AI revolution to actually generate sustainable end-user profits.
And we saw exactly how vulnerable the stock is to that specific narrative just recently. Nebius saw some pretty significant pre-market dips that actually had nothing to do with their own operations.
A sympathy drop.
Yeah, it was tied directly to mixed earnings and guidance from CoreWeave.
When you have a premium valuation in a hyper-growth sector, you are incredibly sensitive to peer pressure.
Absolutely.
If CoreWeave signals that demand is slowing down, or worse, if they signal they are willing to cut their hourly compute prices just to maintain their utilization rates, the market instantly assumes Nebius will be forced to follow suit.
A price war in raw compute would be devastating.
It would crush anyone relying on debt to fund their CapEx. If that commodity layer of AI turns into a race to the bottom, the bears question if Nebius's software moat is genuinely deep enough to defend those 69% gross margins. Or will enterprise clients just abandon the ecosystem to rent drastically cheaper compute somewhere else?
But the bullish counterargument to that entire CapEx sphere circles right back to that customer financing strategy we discussed earlier.
Right. The market isn't fully buying the bear thesis, which is why we are still seeing a 227% return.
The financing strategy completely shifts the risk.
It is the direct mitigation to hardware obsolescence. By structuring these long-term finance deals, Nebius guarantees the cash flows against their capital expenditures for the entire life of the hardware.
They aren't just buying chips and crossing their fingers that they can find daily renters.
Exactly. They secure the hardware to fulfill contracts that are already financed and locked in for multiple years. It effectively pushes the utilization risk entirely onto the client.
And when you combine that locked-in revenue with their ongoing EBITDA profitability, it shows the business model is actually structurally sound right now.
As long as that 100% software attach rate holds up, they are insulated from raw compute price wars. Their clients aren't paying for microchips, they're paying for an integrated platform.
So synthesizing all of this data, the explosive fundamental growth, the sticky competitive moat, but also weighing those highly elevated valuation risks, the current investment thesis lands on a bullish score of 8 out of 10.
I think an 8 out of 10 hits the nail on the head. It perfectly reflects the balance of probabilities.
Mm.
You have 479% revenue growth, the massive strategic upside of the agentic AI acquisition, and that pristine attach rate. They are clearly a dominant player.
But we have to respect the volatility of a 260 PE ratio and those macroeconomic capex cycles.
Exactly.
So the ultimate takeaway from this deep dive is that Nebius Group has genuinely separated itself from the pack. While other infrastructure plays are burning cash, Nebius has achieved vital EBITDA profitability alongside explosive top-line growth.
They've built a full-stack AI cloud ecosystem that customers simply can't leave.
And with that $275 million acquisition, they are aiming squarely at the future of enterprise workflow automation. They are proving they are an evolving software platform, which really sets the stage for massive multi-bagger upside once the broader market's initial capex fears begin to subside.
And regarding the time horizon for your portfolio, you have to follow the institutional flow. The multi-year nature of enterprise AI adoption means this is not a short-term momentum swing trade.
Right.
Investors should really view this as a multi-year hold. You position yourself alongside the smart money and ride out the near-term volatility straight into the massive global AI production ramp we're expecting over the next 3 to 5 years.
I want to leave you with a final thought to ponder as you continue to monitor this sector on your own. We've talked extensively today about the massive capital being deployed to build physical AI infrastructure.
Billions of dollars.
But as that hardware race inevitably commoditizes over the next decade, as processing power becomes exponentially faster, cheaper, and universally accessible to everyone, Nebius's strategy of trapping enterprise data and development within a highly specialized software ecosystem be the only viable survival strategy for the coming infrastructure wars?
It's a fascinating question. Historically, software margins always outlive hardware cycles.
Exactly. Think about how that impacts the long-term wealth potential here. Thank you for joining us for this deep dive, and keep compounding your knowledge.